long last we have a chance to sit and do a bit of thinking as the torrent of central bank statements, company interim reports and macroeconomic statistics slows down this week. But there's still a good handful of data releases which could be worthy of note. From the top down, the focus will be on the UK's inflation figures on Tuesday the 15th and UK unemployment and especially wage growth on Wednesday the 16th. In June, the headline inflation rate, according to the Consumer Price Index, or CPI, cooled to 2.6%, down from 2.9% in May. The Retail Price Index, or RPI rate of inflation, retreated to 3.5% from 3.7%, and we can see the trend in both numbers here over the last 5 years. It'll be interesting to see if these numbers go lower still, with the pound strengthening a little and the oil price broadly unchanged on a year ago. Consumers will be hoping so, since both numbers are running well ahead of wage growth. That came to just 1.8% in May on a 3-month average basis, or 2% if you exclude bonuses, even though employment is at record highs, and the 4.5% unemployment rate is the lowest figure for 42 years. On the corporate front, we're due a smattering of interim results, trading updates and annual general meetings from FTSE 100 and FTSE 250 firms. These include house builder Bovis and Indian miner Vedanta Resources on Monday the 14th, Hargreaves Lansdown on the 15th, and non-life insurer Admiral on the 16th of the month. But the stock that perhaps most capable of causing a fuss in the week ahead is DIY retailer Kingfisher when it releases a second quarter trading update on Thursday the 17th of August. The company is the owner of B&Q and Screwfix in the UK and Castorama and Brico Depot in France and across Europe. As we can see here, the shares are trading at a 12-month low and well below the levels reached in early 2016, just after Chief Executive Veronique Laurie unveiled her 5-year transformation plan, known as One Kingfisher. Investors initially enthusiastically welcomed the plan, which had 2 key thrusts. First, generate a £500 million profit uplift over 5 years through higher operational efficiency across the brands, cutting costs and improving its digital offering. Second, an additional £600 million in capital returns above and beyond its regular dividend payments over the next 3 years. However, the going has got tougher since then. The first quarter trading statement in May was pretty downbeat as group sales fell by 0.6% on a like-for-like basis, hampered by a particularly weak showing in France and teething problems with the strategy that led to product availability problems in the new unified ranges. This is why the second quarter update is so important, even if the full first half numbers will only be released on the 20th of September. When it comes to the numbers, these are the key figures I think you need to watch out for. First, like-for-like sales growth. In an attempt to be helpful, the company reports 3 sales growth figures: total sales in constant currencies, and like-for-like sales in constant currencies. Analysts will focus on the like-for-like sales. In the first quarter, the result was that drop of 0.6%, and as we can see, the trend has been weakening. Second, go beneath the headlines and look at the 3 key regions. That's UK and Ireland, France and the rest, where the key markets are Poland, Russia and Spain. In the first quarter, the UK and Ireland was up 3.5%, France was down 5.5%, and the rest were up 0.7% on a like-for-like basis. Finally, keep an eye out for commentary on One Kingfisher and any additional costs associated with it, as well as any fresh guidance on margins and progress with the share buyback programme. Thank you very much for watching, and I look forward to seeing you next time.